Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is February 28th, 2025. Good morning, everyone. I'm excited to share a deep dive into today's market insights, trends, and some of the biggest stories making headlines across the financial world. So grab your cup of coffee, settle in, and let's jump right into it.
Let's start with a quick market overview. Today we're seeing some notable movements across the major indexes and cryptocurrencies. The S&P 500 closed at roughly 5,862, having retreated by about 2%, while the Dow Jones recorded a drop too, settling around 43,240 with a change of nearly 0.6% downward. The Nasdaq, which has become somewhat of a barometer for tech stocks these days, slid by nearly 3.5% to close at around 18,544. Even the Russell 2000 showed a decline, dropping by close to 1.5%, levels now near 2,140.
And don't think our digital currencies were immune to this storm. Bitcoin fell by about 3.4% to settle near 81,792, and Ethereum wasn't far behind with a drop around 6.3%, closing at roughly 2,159.
It appears investors are feeling a bit jittery today, with waves of caution reverberating through both traditional equities and the cryptocurrency space. The broader market sentiment suggests that headwinds are being felt across the board with these declines, fueling a period of rebalancing and perhaps prompting some traders to consider stepping back and reassessing risk positions.
Moving on, let's examine some major trends and delve deeper into the storyline of our current market environment. One of the dominant themes we're witnessing is the impact of heightened trade tensions and tariff policies. In recent weeks, developments from the Trump administration concerning tariffs have stirred considerable debate. The headlines have been screaming out that Trump's tariffs are about to hit over $200 billion in U.S. Canada-Mexico cross-border rail trade. This isn't a minor inconvenience, it's a significant challenge of an industry that moves auto parts, oil, lumber, agriculture products, and chemicals critical components linking these three economies.
Now you might be asking, what does this mean for the everyday investor? Well, consider that over $200 billion in trade is routed through these freight rails. It's not just a number, it represents shipments of essential goods that fuel both the industrial engine and consumer market. When tariffs come into play, costs rise for manufacturers and ultimately highlight the pressures on the entire supply chain. The rail industry itself might see declining margins as carriers try to absorb extra costs or pass them on to shippers, potentially triggering a ripple effect across sectors, particularly in transportation and energy. And speaking of energy, that brings us right into our next story.
Oil prices have been under a cloud lately, and today's narrative fits into that picture as well. Oil futures were on track for monthly losses on this day February, being particularly challenging on the back of worries over tariffs and the broader global economic outlook. There remains a significant concern that these trade tensions, amplified by new tariff plans, could hinder economic growth by limiting global trade flow. When oil prices take a hit, we see a domino effect on everything from gasoline prices at the pump to the profit margins of energy companies. And hey, if you think your car's gas gauge is dropping faster than your portfolio, you might be onto something.
Adding another layer to this economic complexity, our financial news has also drawn attention to what some analysts are calling the burst of the so-called bro bubble. The phrase might conjure images of a wild party, but it's far from humorous when it comes to serious market speculation. This bubble expanding primarily within certain cryptocurrencies and speculative tech stocks has been under scrutiny by strategists from major institutions like Bank of America. One strategist outlined key levels to monitor for assets such as the Nasdaq, Palantir, and several others. The observation here is that the testosterone-fueled rally that many investors have been riding might be nearing its natural conclusion. It's a wake-up call to anyone who might be betting on a quick ride on the wave of speculative tech investments.
In addition to these major themes, there's another notable piece. U.S. advanced wholesale inventories came in with an unexpected increase of 0.7%, where experts had anticipated a decline of 0.5%. This could imply a sense of stockpiling ahead of the tariffs coming into full effect. In a way, it might seem funny if you're familiar with the sometimes erratic behavior of markets and consumers. This is simply yet another example of how data can defy expectations and leave analysts scratching their heads. The market sentiment here is mixed. On one hand, inventories increasing could suggest robust demand, but on the other hand, it might be a harbinger of caution as businesses brace for the impact of new tariff measures.
Let's now transition into a comprehensive look at some of the important stories shaping today's financial conversation, as there are plenty of details to unpack. First, we have the repeated headlines concerning Trump's tariffs impacting cross-border rail trade. This story has been amplified by repetition across multiple news outlets, reinforcing its significance. It's a vivid reminder that trade policies and tariff decisions are not abstract government maneuvers. They have direct consequences on the flow of goods and the operational profitability of transportation companies. The question here for our audience is, can the current leadership navigate these trade tensions without choking off the lifelines that have, for decades, underpinned the economic fabric of North America?
Next, we have the central theme of falling oil prices. The narrative is consistent. Oil futures are sliding, reflective of both macroeconomic concerns and geopolitical tensions. Investors are acutely aware that energy is a linchpin in global markets, and pressures in this sector can signal broader economic vulnerabilities. With crude oil prices under pressure, many market watchers are wondering if this is the beginning of a lengthier downturn in energy markets, or merely a temporary blip resulting from tariff-related anxieties. It's always interesting to note how oil, often considered the canary in the coal mine for global economic health, sets the tone for broader market confidence.
Then there's the intriguing, somewhat eyebrow-raising commentary on the bro bubble. The speculators in tech and crypto markets have, in recent months, often been compared to kids at the candy store, with adrenaline-pumped exuberance sometimes overshadowing fundamental valuations. As the bubble begins to deflate, we're left to ponder on which companies or assets will floor first. Will it be the overhyped tech giants or the high-flying cryptocurrencies that have been riding this wave? The strategic-level perspectives provided by financial analysts add layers to this debate, reminding us that market cycles are cyclical indeed.
Also worth noting is the data on U.S. wholesale inventories. That positive shift of 0.7% versus the expected drop could be interpreted as a sign of shifting business expectations. If companies are indeed bracing by building up their stockpiles, it might indicate that they are anticipating disruptions. On the flip side, it could be a sign of latent optimism about meeting future demand. It's essential that we keep an eye on these inventory numbers, as they are often precursors to broader trends in manufacturing and retail sectors.
Beyond these primary stories, the market discussion doesn't end there. Digging a little deeper, we see the market's response to these events painting a picture of widespread caution. Across the indexes, we see declining numbers, and while bearish sentiments dominate today's press, it's important to remember that market corrections, albeit painful in the moment, can sometimes be healthy and necessary recalibrations. A quick reminder here to our listeners, sometimes the market behaves like your friend who insists on late-night karaoke. It may be off-key at times, but it's often an emergency signal that something needs to change. Learning should MT feel like a full-time job, and neither should your approach to deciphering market signals.
Let's now shift gears to analyze the key sectors affected by today's news. In the technology sector, the Nasdaq's performance today, with a slide of nearly 3.5%, is an area that demands our attention. The burst of the bro bubble particularly impacts this sector. We've seen tech stocks in a feverish rally that, while exciting, significantly stretch their valuations. The current decline may prompt investors to exercise prudence, retreating from overly aggressive positions and instead favoring companies with solid balance sheets and proven earnings. The big question here is, are these tech stocks destined for a long-term correction, or can innovation and strong fundamentals provide a soft landing? It's a debate that will continue to animate boardrooms and trading desks alike.
On the energy front, oil futures tell a telling story. With prices demonstrating weakness amid tariff worries, energy companies are under scrutiny. This isn't limited to just the crude market. Increased tariffs can raise operational costs for energy producers, particularly those who rely on refining and transportation, and even influence investor sentiment toward alternative energy stocks. One might joke that the oil market is acting like a teenager who just got grounded. It's not showing up at the usual places with the same verb. However, there is a silver lining. Lower oil prices can sometimes benefit consumers and industries that rely on fuel, though the broader implications remain complex in a world interlinked by global supply chains.
The financial services sector is also in the spotlight today, especially given the unusual inventory data. The slight uptick in wholesale inventories, contrary to expectations, has sparked conversations about consumer behavior and corporate strategy. This phenomenon may hint at short-term strategic stockpiling as companies attempt to navigate the uncertain landscape of tariffs and potential cross-border trade interruptions. Banks and other financial institutions that underwrite these businesses are watching closely, as any significant shifts in supply chain dynamics could impact lending, risk assessment, and even the overall stability of the financial markets.
Turning our attention to the global market implications, it is clear that the policies of one nation, perhaps driven by a renewed sense of nationalism and protectionism, can have far-reaching impacts. The U.S. tariffs on cross-border rail trade not only affect domestic carriers, but also influence international trade flows. Canada and Mexico, as key partners, may find themselves grappling with additional trade frictions. This is an era where local policies are in constant dialogue with global consequences, and investors worldwide are remembering that economic interdependence remains as strong as ever. How will other regions adjust? Will we see the emergence of alternative supply chains? These are the big questions that every global investor should be pondering.
The expert insights and predictions for today's market lean on caution, but also on opportunity. Many analysts are suggesting that today's declines, while part of a broader trend of uncertainty, could offer the attractive entry points for long-term investors. When prices are down, it might be the perfect time for buyers' markets, assuming one has done their homework and understands the underlying fundamentals. We've seen corrections in the past create opportunities for growth over the longer term, and some experts are calling today's drop in the S&P 500 and Nasdaq a reset of sorts, a chance for new money to step in. Of course, this analysis comes with the standard disclaimer that past performance is never a guarantee of future returns.
Now, if you're an investor, you might be wondering what the future holds in light of these developments. Let's take a moment to reflect. The tariffs stand to reshape North American trade for years to come. Could we be on the cusp of a significant realignment where supply chains are reconfigured to bypass these new costs? And in the energy space, will subdued oil prices eventually trigger a rebound? Or is this an indicator of deeper, more structural issues in global demand? The conversation about market cycles, valuation bubbles, and economic resilience always brings us back to the importance of a diversified portfolio and a keen eye on risk management.
I must also highlight the humorous side of all this market drama. There's a running joke among traders that the only constant in the market is uncertainty. And today, uncertainty is practically throwing a party with all these conflicting signals. It reminds me of that friend who always says, better safe than sorry, right before making a wild bet. Sometimes we chuckle, even if our portfolios don't. But humor aside, the key is to remain balanced and informed.
Before we wrap up, let's summarize some of the most essential takeaways from our discussion today. We started with a quick market overview that highlighted declines in major equity indexes and cryptocurrencies, clear signs of a jittery market. Then we delved deep into the effects of emerging tariff policies on North American rail trade, which could have a cascading impact on various sectors, particularly transportation and manufacturing. Interwoven with these stories are concerns over falling oil prices due to broader macroeconomic pressures, along with growing skepticism about speculative tech and cryptocurrencies as evidenced by the bro bubble narrative. Additionally, the surprising uptick in advanced wholesale inventories adds another layer of complexity to our understanding of market logistics and anticipation of future demand.
Each of these themes isn't isolated. They are intricately connected by the threads of global trade, investor sentiment, and economic fundamentals. As we move forward, it will be critical to monitor not only these headline numbers, but also the micro trends that signal adjustments in corporate behavior and monetary policies.
As we open the floor to some expert analysis and predictions, let me ask you this. Do you believe that today's tariff measures will force businesses to overhaul their supply chains? Or could there be a counteracting force that cushions the blow? And in the realm of tech and crypto, are we witnessing a healthy correction that will ultimately lead to more sustainable growth? Or should investors brace for further turbulence? These are the sorts of questions that keep us up at night, and they underscore the dynamic nature of our financial landscape.
Looking at technology more closely, we expect that sectors like software, semiconductor manufacturing, and digital infrastructure might recover stronger once the speculative excess dissipates. Investors may begin to favor companies with strong fundamentals over those that have enjoyed a period of rash growth fueled by hype. Meanwhile, in the energy sector, the outlook remains a bit of a mixed bag. While decreasing oil prices could provide some relief to consumers, companies that hinge on high margins might struggle unless they quickly adapt to the evolving global environment where alternative energies come into play. And let's not forget, finance and retail are watching these changes closely, making decisions based on both inventory levels and international trade dynamics.
The global picture remains complex. European markets are subtly influenced by what happens across the Atlantic, while Asian markets certainly have their own pulse dictated by industrial production and export dynamics. Emerging markets, on the other hand, may face volatility if global trade slows down, a reminder that in today's interconnected economy, no market operates in isolation. Could this be a precursor to more localized policy experiments in response to global pressures? Only time will tell, but it certainly makes me wonder, how might emerging economies recalibrate if these trade tensions persist?
Mm. In wrapping up our conversation today, I want to emphasize that while market downturns tend to be a source of anxiety, they also serve as an essential checkpoint for realigning strategies and uncovering value. The key for investors is to maintain a cool head, stay informed, and diversify their portfolios to mitigate risks while remaining nimble enough to seize opportunities as they arise.
I encourage all of you to share your thoughts and voice your questions. Are you rethinking your positions on tech stocks in light of the so-called bursting bubble? How do you plan to adjust your portfolios in the face of tariff-induced uncertainties? These are not just hypothetical questions, they are the crux of active, informed investing. Together, by engaging in these conversations, we can ensure that learning about markets feels more like a lively discussion among friends than a grind that takes over your day. Remember, learning should feel like a full-time job.
As we conclude today's discussion, let's take a moment to recap the key takeaways. The major indexes and cryptocurrencies are in a downtrend with noticeable declines today. Trade tensions and tariffs are exerting significant pressure on cross-border logistics, particularly in North America. The energy sector is feeling the sting of falling oil prices among global economic concerns, and the tech space is beginning to see a correction after an exuberant rally driven by speculative investments. These developments, while challenging, open the door for strategic rebalancing and, for long-term investors, potential buying opportunities.
A huge thank you to our listeners for joining me today on the PAI Morning Briefing. I hope you found this detailed conversation both informative and engaging, and that it provides you with a thoughtful framework as you navigate your own investment strategies. Remember, you can always ask questions to our AI Copilot, and our team at Pantheon AI is here to serve as your information copilot as you make decisions in these dynamic times.
Until tomorrow, keep your mind sharp, your strategies flexible, and your humor intact as you ride the waves of the market. I'll leave you with this thought. In an ever-changing economic landscape, how do you balance the temptation of a riskier venture with the tried and true fundamentals that have served generations before us? I look forward to exploring that and more with you in our next episode. Thank you for tuning in, and have a great day.
Learning should feel like a full-time job.